This is an analysis that I had done in June. I had, in fact, been on several TV programs. I even did a webinar on this. That if you look at this was again, I mean, the data, if you go into, brings up so many interesting things. So we knew this 15-16% long-term compounding of the Indian market. So if you had invested 100 rupees in 1979, that would have become 44,000. That was the number. Said, like, suppose you missed out on 10 good days. This is 40 plus years, and 10 good days doesn't seem like a lot of days in 40 years. What happens? And but the thing is that if you miss out on just the 10 best days of the market, that 44,000 comes down to 15,000. So 2/3 of your returns gone in 10 days. If you miss out on 30 good days, which is less than an average of 1 day a year, your return comes down to less than 4,000. Essentially, 90% of your return just disappears. So that is the skew. And the other thing which we saw was that these good days come in when again sentiment is poor, usually after a fall. So in June, I had said very, very clearly that now the risk really is in not being invested rather than being invested. Because if you're not invested, you can miss out on a big up move. And I later on checked that day that when I said it, I mean, I said, I don't know whether this is the bottom, but it is somewhere there. And that day, the Nifty was 15,293. So, in 2 months, you've got a 18% move. So that is the thing, oftentimes people just keep, and yet, I mean, we went and told all our clients that this is the time to get in, but very few actually did. I mean, people just keep sitting on the fence that we'll do it once the dust settles, when things are clearer, but that is always a bad strategy. If you go to COVID time also, COVID, the March 2020, beginning of March, we said, again, this is on a public platform, that I said, this is something very unprecedented happening, because that time Italy and Japan had shut schools, and you had all these visuals of the Rome's tourist attractions with nobody there. I mean, later on, we got used to those visuals, but that was the first time I saw something like this. And I said, this I have never seen. I mean, even during the World War, nothing like this happened. So we totally moved out of equity in our multi-asset products. We moved into cash, we bought insurance. So when the fall came, we fell very little. So 35-40% for most funds. Between our global and Indian products, the range was, I think, 8 to 11%.
Sure.
But then on March 23rd, again, we said publicly that now it is time to get back in. So when people say that, tell us when to get out and get in, I said, even if I tell you, will you be able to do it? If I told you on March to get out and March 23rd get in, would you have done it? I mean, we as a fund manager can do that. But because if you missed out on that from that March 23rd to April end, which is a period of roughly 5 weeks, both India and US were up 28 to 30%. So if you miss out that move, again, you can't make it up. So, I mean, ideally, what you should be able to do is that if you can sidestep the crashes, either through insurance or otherwise, and then be there when these rallies come or the up move days come, that is the holy grail. That is what you aspire to. But very difficult for people to get over that whole mental blocks and
of course
being scared and all that. So that is the thing.